Division 7A, two words that make accountants wince, and that most business owners have never heard of until it is too late. I am Tin-Lok Shea, tax lawyer at Australian Tax Experts. If you run your business through a private company, and you have ever borrowed from the company, had it pay a personal expense, or left a trust distribution unpaid, this presentation is for you. Over the next few minutes, we will cover what Division 7A does, how to stay inside its safe harbour, and a landmark High Court decision from June 2026 that has just reshaped the rules. Let us get started.
First, why should you care? Four numbers tell the story. 8.37%. That is the ATO's benchmark interest rate for the 2025-26 year, down from 8.77 the year before. It is the minimum rate a private company must charge on a shareholder loan for it to stay compliant. 7 years, the maximum term for an unsecured loan, stretching to 25 years where the loan is secured by a registered mortgage over real property. 0%, the franking credits attached to a deemed dividend. Unlike ordinary dividends, Division 7A dividends come with no franking credits, so you pay full marginal rates with no offset for the tax the company has already paid. And the 30th of June, the date by which a minimum yearly repayment must be made. Every single year the loan is on foot.
So what does Division 7A actually do? It sits in the Income Tax Assessment Act 1936, and it targets money leaving a private company in ways that are not salary and are not formal dividends. Where a private company makes a payment, a loan, or forgives a debt in favour of a shareholder or their associate, Division 7A deems that amount to be a dividend, an unfranked dividend, taxable in the recipient's hands at their marginal rate. Here is the part that surprises people most. Your intentions are irrelevant. A director who borrows from their company fully intending to repay it will still be caught if the loan is not on compliant terms. The deeming happens automatically in the year the loan is made. It is only a loan, is not a defence. Division 7A says otherwise, unless strict conditions are met. There are three common ways money gets caught. Payments. The company pays a shareholder's personal expense or transfers property to them. Think school fees on the company card or the family holiday booked through the business account. Loans. Money lent or advanced to a shareholder or an associate without compliant terms, including the informal drawings that build up in a loan account over the year. And forgiven debts, where the company simply writes off an amount a shareholder or associate owes it. Each of these ends in the same place, a deemed unfranked dividend, assessable income at the recipient's marginal tax rate. The label you put on the transaction does not matter. The substance does. The good news is that Division 7A has a safe harbour. A loan escapes deemed dividend treatment if four conditions are met. 1. There is a written loan agreement in place before the earlier of the due date and the actual lodgement of the company's tax return for the year the loan was made. 2. The loan charges interest, at least at the ATO's benchmark rate, which is 8.37% for 2025-26. 3. The term does not exceed the maximum, 7 years for an unsecured loan, or up to 25 years where it is secured by a registered mortgage over real property. And 4. Minimum yearly repayments are made by the 30th of June every year the loan is outstanding. Miss a repayment, and the shortfall itself becomes a deemed dividend. Where do things usually go wrong? 4 traps come up again and again. Informal loans, drawings taken through the year with no written agreement. These are deemed dividends waiting to happen. Personal expenses through the company, school fees, cars, holidays. Owners often do not realize these are payments for Division 7A purposes. Missed minimum repayments. The agreement might be perfect, but if this year's repayment falls short, the shortfall converts into a dividend. And paperwork signed too late. A loan agreement put in place after the company's lodgement day does not rescue the loan. The safe harbour is lost. If any of these sound familiar, do not panic, but do keep watching, because the fixes are usually simpler when you move early.
Now to the issue that has kept advisors busy for the best part of 2 decades, unpaid present entitlements, or UPEs. Here is the classic structure. A discretionary trust distributes income to a private company beneficiary, often called a bucket company, but never actually pays the cash across. The company's entitlement simply sits there, unpaid, while the trust keeps using the funds. Since 2009, the ATO's view was that these UPEs were, in substance, loans from the company back to the trust, and therefore caught by Division 7A, with all the deemed dividend consequences we have just covered. Thousands of family groups structured their affairs around that view, entering complying loan agreements over their UPEs. Then came Bendel. On the 10th of June 2026, the High Court handed down Commissioner of Taxation v. Bendel. By a 5-2 majority, the court dismissed the Commissioner's appeal and held that an unpaid present entitlement is not a loan for Division 7A purposes. Where a private company simply does nothing in respect of its entitlement, it does not demand payment, does not lend the money back, just leaves it sitting there, no Division 7A loan arises. This overturns the position the ATO had maintained for more than 15 years, and the ATO has accepted the outcome. Its decision impact statement, published on the 26th of June 2026, confirms that the contrary public ruling will be withdrawn. The bottom line: merely leaving a trust distribution unpaid no longer creates a deemed dividend.
But, and this matters, UPEs are not suddenly risk-free. 2 sets of rules survive Bendel. Subdivision EA. If the trust takes those funds and pays or lends them to a shareholder of the company, or their associate, or forgives such a person's debt, a deemed dividend can still arise. And Section 100A. If the entitlement came about under a reimbursement agreement, the trustee can be taxed at the top marginal rate. On top of that, the ATO is actively rewriting its Division 7A guidance and may issue more. So before you make year-end trust distributions or unwind arrangements you put in place under the old view, get current advice. This area of the law has just moved. Make sure your structure moves with it. So what should you do if Division 7A may apply to you? 4 steps. First, review your loan accounts and UPEs. Identify shareholder loans, unpaid entitlements, and personal expenses the company has paid. Second, bring loans into compliance. Put written agreements in place and make catch-up repayments where they are available. Third, consider a voluntary disclosure. Approaching the ATO before they come to you generally produces far better outcomes than waiting for an audit. And fourth, get advice before restructuring. Some historical problems need more than paperwork, and the wrong fix can be worse than the original problem. The consistent theme: Division 7A issues are usually fixable, and they are fixed most cheaply when you act promptly. This is exactly the work we do at Australian Tax Experts, where tax lawyers and accountants work as one team. We run Division 7A health checks, reviewing loan accounts, UPEs, and trust distributions to find issues before the ATO does. We fix and document compliant loan agreements, repayment plans, and corrective action for past years. And we handle ATO engagement, voluntary disclosures, objections, and negotiated outcomes, managed by specialists who do this every day. Whether you are tidying up a loan account or rethinking a trust structure after Bendel, we can help you get it right. If you have a shareholder loan, a trust arrangement, or an unpaid entitlement that may be caught by Division 7A, talk to us before it becomes an ATO problem. Visit australiantaxexperts.com.au/contact to arrange a confidential assessment of your position. Thanks for watching, and remember, this presentation is general information only, not personal tax or legal advice.